Hi friends, this video is for someone who would like to know more about how to pick long-term equity stocks. As you know, there are 5,000 plus companies in NSE BSE. Now how do I pick those minimum quantity of stocks that I would need? And it need a lot of filtering out of the good stocks or basically filtering out of the bad stocks, right? So when I say long-term equity investing, so I am talking about a time horizon of 5 to 10 years. So you should be able to hold it for 5 to 10 years around or even longer if you wish, right? So I am targeting here about 10 stocks. 10 to 15 is okay, but around 10 stocks is what I am targeting. So what are the parameters do I see? First is the market capitalization. Around a minimum market capitalization of 5,000 crore, a maximum of 500,000 crore. Now why is this? When the market capitalization is too less, there is a good chance that manipulation might happen and things may go in a way which you're not expecting. And when the market capitalization is too high, such stocks are normally the traded stocks, and I don't want to be in that for the longer term duration. So the logic here is basically you pick stocks which are 5,000 crore to 500,000 crore, so you get a good mix of small, medium, and larger companies. So small cap, mid cap, and the large cap. Now PE, price to earning ratio, very important parameter to judge whether the company is expensive or not. To its earning, what is the price, right? So generally I look for industry PE and the 10-year average PE of the company. When both of these when the current PE is at least 1.5 times within this, meaning suppose the current PE of the stock is 30, while its industry PE is 20, okay, and the 10-year average is also around 20, so I am okay to buy. So on a stock which has industry PE and 10-year average of 20, while the price is 40, I may not be interested. Now, next parameter is return on equity. This is basically how much return the company is making for the equity that it is holding. So I look for 5 and 10 years of equity, return on equity, at least 10. Okay. So for every equity, there is a return of 10. Now, return on capital employed. So as you know, every company has a certain capital, and how much is the return on capital employed. So I look for 5 and 10 years, at least 10. Debt to equity. So whatever the debt the company has to the equity, the entire equity it has, it should be less than 1. The lower the better. Now promoter holding at least 50%, and sometimes the promoter may pledge their stocks for whatever the reason may be. It should not be more than 5%. Now next is the operating cash flow. Operating cash flow, now this is not for finance or banking companies, because their cash flow will be negative most of the time because of the way the business works. But for other companies, the operating cash flow of 5 years and 10 years should be at least positive. That is something I see. Next is the price to earning growth. So every year the company's earning will grow, and price to earning growth should be less than 1, but definitely not negative. The higher the one, more than 1, you may have to really see what is happening, but if it is negative, it is a red sign. Now, current market price around 100 to 10,000 rupees. Now, some of you might think why this need to be, but I prefer not to pick stocks which are less than 100 and more than 10,000 for the simple reason that there is a good room. I mean, you have a lot of stocks to pick. I mean, you don't need to be going to the either extreme of it. So I prefer 100 to 10,000. And the price action I see here is on a monthly basis, and look for the support area. And what is the exit? And we all know, right, when we pick the stock for long term, the biggest question comes when the stock starts falling, right? What do we do? So when you know all these things about the company, that it is fundamentally good stock, you won't panic. So basically when it is falling and then the rise starts again, you will add more. Now when should you exit? Ideally when there is change in the fundamental of the company. One reason, one example could be the annual annual sales or annual revenue, annual profit, there is a decline 2 years, right? So back to back, this could be one example. Another example could be there is a significant change in the management, there is a significant change in promoter holding, or there is a pledged stocks are increasing now. It could be any of the fundamentally selected reasons. So you have selected the stock for certain reasons, and there is a change in that reason. Now it is a good reason for you to exit. Otherwise, you should keep holding as long as possible, and you should not worry about any dip. May it be 5%, 10%, up to 20-25%. There is no need to be panic. And it is quite common that even the fundamentally good stocks go down, but they pick it up and rise back again. And while exiting, I will also look based on the technical chart, which is again monthly basis. So if you learn this art of picking fundamentally good stocks and stay put and stay hold them for long term, the magic of compounding works wonder, and you are going to generate good wealth. Of course, this is not for someone who want cash flow on an yearly or a monthly basis. It could be like once in 5 years you may get good cash flow, but it is not for somebody who need a regular churn around of the cash flow, but this is more for wealth generation. Hope you got some insight into the long-term equity investment. If you like the video, please like it and subscribe. Thank you.